Kraft Heinz, ticker symbol KHC. What a disaster. They just cut their dividend. The earnings are really bad. This stock has tumbled. It fell 27% in a single day of trading today. I just published a video on my YouTube channel about saving money, and everyone in the comments has been asking, Ian, what do you think about Kraft Heinz? So I am filming this video today. I am absolutely exhausted. This has been a long day. I got up at 5 a.m. I drove all the way from the Bay Area to Sacramento for some real estate business. I am now driving home. I'm in Vacaville, so I'm taking a break to stretch my legs, taking a break to enjoy some Starbucks. In terms of full disclosure, I am long Starbucks, ticker symbol SBUX. I own that stock in my personal stock portfolio. And anyways, I just want to address this question because it's real time. I'm getting a lot of questions about it, and I want this video to be in real time for all of you out there thinking about Kraft Heinz. Also, I just wanted to do a vlog. It's been a while since I've done a vlog, and so I want to address some other questions and topics on the way home. I'm going to make a few stops today on the way home to stretch my legs, to break. And I will shoot a short video about dividend investing each time with each break that I take. And so it's going to be fun. It's going to break it up, make this road trip a little bit more fun. By the way, if you live in the greater Sacramento area, please comment in the comments below. Perhaps I'll do a meetup there one day because I am in Sacramento once in a while for business. And so it's easy for me to organize a local PPCE and dividend investing meetup there. Anyways, I want to jump right into it. So the history with me and Kraft Heinz, I'm just going to reiterate, I will link in the description below. I've done a few videos on this, but I used to own Heinz. Heinz got taken out. It got taken out by private equity, and then it reemerged in conjunction with Kraft as a public company. I personally did not like the way that Heinz was taken out. I don't feel that shareholders got a fair premium on the stock that they owned, and so it kind of left a bad taste in my mouth ever since that happened. Anyways, all this stuff happened, all this financial engineering, it got brought public again, and with Warren Buffett and 3G Capital, I know a lot of people in the dividend community like this stock. I actually initially did not like the stock, and I did a video on this. The reason that I did not like it is because, quite frankly, I had a poor experience with Heinz. I absolutely loved the company Heinz. I wanted to own it forever, but the way it got taken out by private equity and then reemerged in conjunction with Kraft as a public company, I just didn't like all that financial engineering, and quite frankly, I think the only people that won there were the financial engineers. I don't think the shareholders really got a fair deal, but that is just my personal opinion. I could be wrong. That is just how I felt in the whole situation. But anyways, it reemerged as a publicly traded company. I initially really didn't like it, but over time, so many people from the PPCE and dividend investing community were saying, hey, Ian, take a look at Kraft Heinz. What do you think about Kraft Heinz? A lot of people in the community own it and like it. And so my opinion got swayed over time. And at one point, late in 2018, I was really close. I was thinking about buying it, but at the end of the day, my gut just told me no. I already own General Mills, ticker symbol GIS, Campbell's Soup, ticker symbol CPB. In terms of full disclosure, I am long General Mills and Campbell's Soup, ticker symbols GIS and CPB. I own both of those in my personal stock portfolio. And I kind of rationalized, hey, Ian, you don't need a third one. You've got enough exposure in this space. Yeah, Campbell's Soup and General Mills, they're smaller positions. But eventually what I decided is rather than add Kraft Heinz, what I'm going to do is just keep adding to the existing positions I have, especially General Mills. I keep adding to that one pretty regularly, actually, even to this day. And so I didn't do it. I trusted my gut. Ultimately, the reason I didn't buy it, honestly, is because I just don't like financial engineering. I come from an operational business background, and I really, really respect the people that run the business. When these big games of chess and poker are played, financial engineering, private equity, this and that, it does not resonate with me. That is not my thing. In fact, I oftentimes frown upon that. I really respect the people who actually operate and run companies. And so when all these M&A gets going, it quite frankly is not where I tend to gravitate towards. It's not my thing. And other people, they may like that. It might be their thing, but again, it's just not for me. So that didn't resonate with me. But also, the Kraft portfolio, I think, is kind of weak. I think the Heinz brand is super strong. Heinz on its own is strong. But the Kraft brand, they own like Oscar Mayer, Jello, like Kraft mac and cheese. These are types of things, quite frankly, that aren't as popular anymore. And I believe that the Kraft portfolio, in my opinion, it could be wrong again, but just my opinion as a consumer, is a bit weaker than the General Mills portfolio and the Campbell's Soup portfolios. And so for me, I just couldn't stand behind it. That being said, I want to give some perspectives today on what I think about what happened and what I hypothetically would do if I owned it, what I'm gonna do going forward if the thing falls more. And so anyways, I have a few thoughts. I actually jotted these down earlier today, so I'm gonna keep glancing down at my notes. But one, this is why I diversify. I diversify for this very reason. These guys just cut the dividend from 0.625 cents, or sorry, 62.5 cents per quarter down to 40 cents per quarter. This is a dividend decrease of 36%. The reason they cut the dividend is the company is under pressure. The numbers are not good as expected, and there are two reasons they're facing troubles. One reason is because rising transportation and materials, aka food costs, but the other reason is consumer preferences and challenges, I would imagine, within their Kraft portfolio. I have to imagine the Heinz portfolio's doing all right. And so pressures are being faced. Also, what they're doing at this time is they're taking a large impairment charge. What this means is they're basically, I didn't write down the exact number, but there's a very large charge related to Kraft, and in particular the Kraft and Oscar Mayer trademarks. These are being carried as assets on the balance sheet. They are taking an impairment charge that basically writes down the value of these assets considerably. By taking that impairment charge, they're basically saying, hey, we overpaid for Kraft. We need to take a one-time impairment charge. And what it's going to do in terms of GAAP EPS, I did a video on this, I'll link in the description below, all about GAAP reporting, is it affects the earnings per share quite aggressively in the short run because this impairment charge is being subtracted from the current quarterly results. And so this impairment charge is really big, and they're basically saying, hey, we overpaid for Kraft, and these trademarks are not worth what they used to be. And so their balance sheet's going to be affected as well here because assets are taking a haircut, liabilities stay the same, and so shareholders' equity is evaporating. Although with these kinds of companies, quite frankly, I don't really care about shareholders' equity. I care about it with a bank or an insurance company. But with a stock like this, it's largely a consumer non-cyclical brand type of company. I don't take these types of goodwill on the balance sheets, especially the value of trademarks, that seriously. And so I don't really worry about the impairment charge too much, but I do worry that it indicates they overpaid. The Kraft component of the business was valued too much, too high when this whole financial engineering happened. And again, this is one of the reasons I just don't like all this financial engineering. It's just not for me. Anyways, I'll tell you, 3G and Warren Buffett are involved in this. I think Warren Buffett, quite frankly, is going to learn some lessons from this. We'll see if he continues to work with 3G and what he thinks about this, but it'll be interesting. It'll just be interesting. And so another bad news out of their earnings report, in addition to the dividend cut, the impairment charge, the bad earnings, the bad weak business, is there is a SEC federal investigation into their accounting principles. And so their accounting is under scrutiny. Did they make a mistake with their accounting? Are they doing it wrong? All of that is under investigation. So needless to say, this thing is just tanking. Free fall, a lot of problems. Hey, here's where I'm at with this thing. I sometimes like a turnaround play. This thing is down now at $34.96. If I take the new dividend, 40 cents per quarter, I multiply by 4, that's $1.60 per year. If I divide that by the current share price, current yield for someone getting in today at $34.96 is a 4.6% starting yield. That's not bad. That's actually a better starting yield than General Mills, which is at 4.3, and Campbell's Soup, which is also around 4.3. It looks like both of those are at 4.3. And so you get a better starting yield on Kraft post the drop. Look, this is not deep discount enough for me. This thing is facing a lot of problems. If it fell into like the high 20s, maybe I would consider buying some. Basically, the way I look at it now is I'm going to stick with my General Mills, stick with my Campbell's, but if this thing enters free fall, like it hits the 20s, I might take a look. I might buy some. I don't really want a 41st stock, but maybe I will if it just enters a complete free fall. I'll look at it potentially as a turnaround play. That being said, both Campbell's Soup and General Mills were down today. General Mills was down about 3%, Campbell's Soup 8%, and they were down in sympathy. They were down because this whole sector is down. This consumer packaged goods, packaged foods industry is facing some challenges, and investors are worried that, hey, when General Mills reports, hey, when Campbell's next reports, are they going to face the same issues that Kraft is facing? Is Kraft a leading indicator? Is this whole industry going to be under pressure? So thought number one is, if this thing enters a free fall situation, I may buy some. That said, it has to really free fall for me to buy some. It's going to fall into the 20s, the high 20s, maybe even mid 20s. The other way I look at this, though, point number two, is I have been averaging into General Mills pretty regularly here. And at this point, I may slow down, because what if Kraft Heinz is a leading indicator of what's to come for this industry? I need to manage risk. There are three stocks I'm buying regularly right now: United Technologies, Pepsi, and General Mills. Those are the three I'm kind of averaging into monthly right now. In terms of full disclosure, I am long General Mills, United Technologies, and PepsiCo, ticker symbols GIS, UTX, and PEP. Probably what I'll do here, quite frankly, is take the money that I'm using each month for General Mills and start dividing it between Pepsi and United Technologies. I'll probably just add more to those two, taper back on General Mills, because General Mills for me now, it's getting closer to that 1% range. I still have a ways to go for it to reach 1% of my portfolio, and I don't really want it much higher than 1. But that being said, look, I've got some good General Mills. I accumulated at these low prices. Maybe I'll nibble, I'll buy some more. Same with Campbell's, I might buy a little more. But ultimately, I think that this Kraft situation, it kind of is an eye-opener that investors, yeah, it's good to buy into the values and get the good starting yields, but also diversification is key, and it's good to exercise prudence and risk management here. And I want to manage my own risk by probably tapering back what I'm doing a bit with General Mills. We'll see. Maybe I'll keep it averaging a few more months here, but eventually I'll take that money and instead divvy it up with Pepsi and United Tech. Those are both top 10 stocks for me anyways, so I want to bolster those. That is my 2019 goal anyways. And so the third point really is diversification. Again, I talked about this already, but it is so key to diversify, and it's important to diversify across industries, across different types of companies and industries. Look, buying Kraft Heinz, General Mills, and Campbell's, for example, that's not diversification. It's three companies that all do the same thing. I mean, it adds a little maybe, but I'm talking about big diversification across industries, like complementing, for example, a Kraft or a General Mills with a United Tech. That's real diversification, and that's why I just bought Chubb, for example, an insurance company, ticker symbol CB. In terms of full disclosure, I am long Chubb, ticker symbol CB. I own that one in my personal stock portfolio. I like to diversify. A lot of people don't believe that they should own as many stocks as I do, because I've got 40 of them, and I know that's a bit out there, but I'm trying to scale my portfolio pretty large here. It's going to be a very large portfolio to pay all of my living expenses, which are pretty high in the San Francisco Bay Area. And so I need a really big portfolio, and because it's going to be big, I just want the diversification. I want to mitigate my risk. And so, but I love being diversified. And so anyways, those are my key takeaways. Again, diversification, easing back on General Mills purchases at this point. Probably a few months from now, I'll start tapering back a bit, maybe a little earlier than I would have otherwise. And then the third big one is potentially buying Kraft Heinz, quite frankly, if it tanks more. Now, I do want to wish everyone the best. I don't want to seem insensitive in this video. I truly wish you the best. If you own Kraft Heinz, if you've been affected by this devastating drop. I wish you the best, and I am rooting for you. And so I certainly don't want this video to seem insensitive or haha, I told you so. Look, I've made my fair share of mistakes in the stock market. The key thing, quite frankly, if you are in that situation, if you did lose some money on this, look, I'm only talking about my personal journey here, so I don't want to get into any specifics other than my own, but these all are learning lessons. And so, if you believe you might have made a mistake, the key lesson or takeaway that I've had from my own mistakes is I like to learn from all of them, and I like to improve it as an investor, and I continue to make mistakes. I honestly look forward to making mistakes sometimes because that's how I learn. And the key thing is not to let it derail me as a dividend investor, because to be a successful dividend investor, it takes many decades and commitment, and you don't want to sweat anything and let anything derail one from the big picture. Anyways, I want to speak here, though, hypothetically. Let's say I'd bought Kraft Heinz. If I owned it here, what would I do, hypothetically speaking? Another way of looking at it is, what if this same thing happens to General Mills? What will I do? I'm just going to hold. I'm not looking to really sell stocks. I don't like dividend cuts. Certainly dividend cuts are awful. I try to avoid them. I've been really lucky so far in recent history. I haven't, I can't even remember experiencing one in recent history. Although I have had companies that have paused the dividend increases, like General Mills, for example, with their whole Blue Buffalo acquisition. They had to pause the increases in dividends till they digest this acquisition because it cost a lot of money. They took on a lot of debt. But that's a lot different than a dividend cut. And anyways, I bought General Mills knowing that. I bought after they purchased Blue Buffalo, after I knew all about that dividend increase pause and the increases. I knew that going in. But anyways, needless to say, I own 40 stocks. If one of them cuts the dividend, I will look at them all case by case. But hypothetically here, I kind of look at Kraft Heinz the same way I look at my General Mills. If General Mills is to go ahead and cut the dividend, what will I do? I will probably hold my General Mills. I'm not looking at this time to sell my General Mills. And it really comes down to the long-term approach. I like to invest in really solid brand name companies. I like to invest in companies for the long term. And I know sometimes that when dividend cuts happen, they will be reversed. They will go up again. And so I like to just take a really long-term perspective on things these days. In the past, Ian, like I used to own this company, BHP Billiton, they were facing tough times. The dividend eventually got cut. I sold the company. And the way I look at it now, quite frankly, is a little bit different. I hate dividend cuts. I don't like them. They will affect future investment decisions. But if I own a company and the dividend, like if it gets eliminated, that's different than a cut. Like let's say Kraft Heinz completely eliminated the dividend. That's a lot different. This is not a General Electric here, in my opinion. This is, if it were like a General Electric type situation, look, I'm completely out, run for the hills, head for the hills. The thing is in my opinion, for lack of a better word, just junk. And again, I hope I don't offend anyone here. If you own a General Electric, I truly do wish you the best. But as it pertains to Kraft Heinz, I don't even think they needed to cut the dividend this much. That's why I'm kind of a little bit perplexed as to why they did this. Again, it gets me thinking about financial engineering and who's really winning here and what 3G gets out of this and this and that. And so, again, I don't know the full picture, but it seems like they made a pretty big cut, and they probably didn't need to make such a big cut, but maybe there's more to this accounting scandal or this accounting probe than meets the eye so far. So maybe it comes to that. But again, I personally don't think Kraft Heinz is a General Electric. I don't think it's that kind of situation. So if I hypothetically owned it here, I'd probably just hold through and wait and see what happens. And look, it's already tanked quite a bit, even before the recent 27% drop today. Now, again, the other way I look at it is if the same thing happens to General Mills, I will probably just hold, but we shall see. Anyways, I know I'm rambling a bit here. Thank you for hanging in with me. I'm doing my best. I'm really exhausted today, but I know you guys wanted to see this video. Anyways, I'm going to get back on the road here. I need to get back on the road, get home at a reasonable hour, but I will check in with you all at my next stop here because I do have one other topic I want to discuss in today's dividend investing video. So I'll catch you in the next segment. All right, everyone. So segment 2 of today's vlog, I'm actually stopping again, not too far from my last stop. I'm in Fairfield this time. I like to stop here because they have a Jim Boy's Tacos. If you're from the Sacramento area, NorCal area, you know what that is. And they don't have these in the Bay Area, so at least to my knowledge. And so I always got to stop on the way home. I really enjoy their burrito. Anyways, maybe when we do our Sacramento meetup, if there's enough folks interested in that from the dividend investing community here, we could either do it at Starbucks or maybe even Jim Boy's. That would be a fun place to do it. So anyways, I want to talk about something in segment 2. And the topic that I want to go over is the fact that I am seeing dividend increases slow down a bit. And so I want to give some examples here. Coca-Cola, they just increased the dividend by 2.6% year over year. That is really low. That's not very high. The last increase that Coca-Cola did last time was 5.4%. So going from a 5.4% year over year growth rate on the dividend down to 2.6, that is not very exciting. Walmart just increased their dividend by 1.9%. Again, this is not very much, although it's similar to last year. They've been pretty slow. They've been slow all along here. Hasbro just increased their dividend by 7.5%. This is as compared to 10.5% last time. So they increased the dividend 7.5% year over year. And last year when they increased it year over year, it was 10.5. So these are really good increases for Hasbro. I wouldn't really complain about it, but it is slowing down a bit. 3M, this is the one that gets me. They just increased the dividend by 5.9%. This is a good increase, but it's very low compared to the 16% increase that they did last time. Last time they increased the dividend 16% year over year. So that is much slower. Both Coca-Cola and 3M much slower. I'll give you another one. Chevron just increased the dividend by 6.3% year over year. I was actually surprised by this one. Last time it was 3.7% year over year. So I'm really surprised. I own this one. I own all of these actually. And it's nice to see, despite oil prices facing some downward pressure, that Chevron feels confident enough to increase the dividend 6.3% year over year. Kimberly-Clark, they just raised the dividend 3% year over year. Same as last time, pretty much, very consistent, but it's kind of low. I was hoping for more. I was quite frankly hoping for more with Kimberly-Clark and Walmart. I know they've been slow in recent history. I was hoping they amp it up, but they're keeping them slow. But what really gets me here is Coca-Cola and 3M. Both of those are much lower than I would have expected. And so why am I going over these dividend increases today? I've done some videos recently about the stock market crashing. And no, what we saw in December was not the stock market crash. That was just a little blip on the radar. That was nothing. In my personal opinion, sometime over the next few years, maybe next 2, 3, 4 years, the market will have a severe correction, and it will be tied to the economy, because the economy, in my opinion, will face a severe correction. It will likely be tied to the massive amounts of government, corporate, and personal debt that is outstanding, combined with rising interest rates, although so far we don't see interest rates rising. And so I think this economy, or at least not rising very quickly, and so I think this economy will sustain itself for a while, but at some point the tide will turn, things will change. And anyways, though, towards the end of the economic cycle, I think what's happening here is some of these companies, they're starting to be more cautious. I think 3M and Coca-Cola are great examples of that. They're being more cautious. They're starting to slow the dividend increases, because it's not the beginning of the bull market. It's not the beginning of the recovery of the economy. It's towards the end. And so I look at this as late stage bull market dividend investing at this point. And it's just a reminder to myself, to everyone out there, that it is always wise to proceed with caution. It's always wise to diversify, to average in, and quite frankly, to model very conservatively. And so even some of the models I've done on this channel, I have looked at prior history of 3M, for example. I take the compound annual growth rate over time and I project it into the future. Well, if I take this most recent dividend increase into account, it lowers 3M's compound annual growth rate, the average growth rate that they've had of their dividend each year. And it changes my projections. And so if you're out there, you're modeling dividend increases for the future, and you start incorporating some of this more recent data and some of these slower dividend increases, it certainly projects a different yield on cost. And so I think this is really important for everyone in the community to be aware of. Does it change my investing philosophy? Does it change what I'm doing? No. Does it allow me to set more realistic expectations about my yield on cost? Yes. And so I do think going forward, I mean, this is very thin data. This is not a lot of data so far, but I certainly foresee an instance where, yes, the crash is still on the horizon. Yes, we're kind of late stage in this economy. Yes, the dividend increases are starting to slow, but they're still coming. And I think just from a yield on cost perspective, at least looking at the short and intermediate term, I'm talking 5 to 10 years out, it may be prudent to lower the compound annual growth rate, the average growth rate of dividends in modeling. But looking certainly 20, 30, 40, 50 years out, obviously all is still good there. And I think there will be cycles, there'll be peaks and valleys over time, and I probably amp up my projections for the long term. But in the next few years, we may be in for some slower dividend increases. And look, there's nothing wrong with that. These companies don't increase the dividend the same rate each year over time. It may be harder to get some yield on cost in the short run, but then again, there still may be companies that surprise us. For example, like Chevron totally surprised me with the greater increase, as did Hasbro. I was really excited to see the Hasbro increase as well, because that's a whole industry that has been facing pressure with the Toys R Us bankruptcy. And so the fact that Hasbro is doing well despite Toys R Us going out of business and still raising the dividend so much, I was really promising to see that, but I was kind of discouraged again by 3M and Coca-Cola. And so today's video, quite frankly, I wanted to have both of these segments because I think they go hand in hand. We see a Kraft Heinz debacle. We see the dividend get cut. And on the other hand, with some of these other stocks, we see the dividend growth rates kind of going a little slower than I think a lot of us thought, at least with Coke and 3M. And it kind of paints a picture. And the picture here is to be realistic, to be not be too hard on oneself, quite frankly, because I'm in this for the long run. I'm in this forever. And just to realize that there are stages to the economy. It is prudent to diversify. It's prudent to exercise conservative modeling. And even some of the models I've done here perhaps could be a little bit more conservative than they even have been. And I think it's just good to be a dividend investor. It's good to have eyes wide open, to be very careful with the numbers and just be realistic with oneself and one's expectations out there. And so I'm not trying to just bring forth a ton of bad news in today's video, but I'm hoping, quite frankly, that out of the bad news often comes some of the best insights for dividend investing and some of the best insights. And this is what builds character. I've been through this before. I've been through it all before. Been investing for over 20 years. And I love this kind of stuff, honestly, because it builds character, keeps it exciting, and it is all good. By the way, in terms of full disclosure, I am long on all the stocks I just mentioned. I am long on Coca-Cola, ticker symbol KO, Walmart, ticker symbol WMT, Hasbro, ticker symbol HAS, 3M, ticker symbol MMM, Chevron, ticker symbol CVX, and Kimberly-Clark, ticker symbol KMB. I own all of those stocks in my personal stock portfolio. And then all the stocks in the last segment I already disclosed. In terms of a friendly disclaimer, today's video is just for fun and entertainment. I'm not a licensed investment advisor. Today's video is not investment advice, literally just for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. Just sharing my journey here on YouTube. This is a very tired PPC Ian today after a long day, so I hope you guys did enjoy this video. I knew it was important to get this completed for everyone in the community. Love to get some great discussion going in the comments section below, so please chime in. And if you appreciate the videos here on PPC Ian, please comment, like, subscribe, share it with your friends. All of that means the world to me. Hey, thank you, everyone. I wish you all an amazing day and a prosperous time investing in dividend stocks. I will see you in the next dividend investing video.